Three key messages from us this week. Firstly, a review of markets, then an update following Theresa May's speech regarding Brexit, and then finally some thoughts on how our portfolios are currently positioned. Last week was a busy week for markets as I digested firstly Theresa May's speech regarding the UK's plan for Brexit, and then readying themselves for the start of Donald Trump's presidency. Away from politics, there was also a raft of important economic data released during the week, which pointed to two key trends. Firstly, continuing improved economic growth, but also the threat of rising inflation. In the US, inflation figures came in at 2%, the highest figure that we've seen year on year for over 3 years. In Europe, similar trends emerging, a 1.1% rise, again the highest since September 2003. Despite the rise in prices, however, the European Central Bank felt no need to take action, leaving interest rates on hold at 0%. Last week saw the much anticipated speech by the British Prime Minister Theresa May outlining the UK's position regarding Brexit. Going forward, the UK will not seek to be a member of the single market nor the customs union. Later in the week, addressing world leaders at the Global Economic Forum in Davos, Theresa May went further, suggesting that the UK will look to step up its leadership on a global basis. The pound rallied in the aftermath of Theresa May's comments, reflecting improved clarity, but also the fact that she'd adopted a less aggressive tone than maybe had been anticipated. For us, however, there was nothing substantially new in her comments. The UK will still seek to leave the single market and the customs union, and also seek to take a greater control of immigration. This was not a soft Brexit option in our opinion. Thinking about sterling, our views haven't changed on the back of her comments. We still see sterling as strategically undervalued, but in the short term continue to see political risks. Rising global growth expectations mark this as an environment that should favour risk assets, particularly equities when compared to more expensive government bonds. In our portfolios, we've got larger weightings in more economically sensitive regions such as Europe and Japan. As an example, the valuation in Europe looks favourable when compared to the US. European equities trading on a forward multiple of 13 times compared to the US slightly more expensive on 15.5 times earnings. This valuation advantage, combined with improving sentiment in the form of rising manufacturing activity and industrial production, give us more confidence in these regions.